Welcome, future leaders, strategists, and financial architects. You are about to embark on a journey into one of the most demanding, dynamic, and potentially rewarding career paths in the modern economy: United States investment banking. Over the course of this series, we will dissect the essential skills required to not only enter this competitive field, but to thrive within it. We will break down the top 5 core competencies into 15 detailed chapters, giving you a comprehensive roadmap to what it takes to succeed. Before we dive into the core content, it is critically important to establish the purpose of this series. The information provided here is for educational and informational purposes only. This is not, and should not be interpreted as financial, investment, legal, tax, or direct career advice. The world of finance is heavily regulated, and individual circumstances vary greatly. Therefore, you should always consult with a licensed and qualified professional for advice tailored to your specific situation. Our goal is to illuminate the skills and mindset required for a career in this industry, not to provide guidance on personal financial decisions or guarantee career placement. By continuing, you acknowledge that this content is for educational exploration. So, what exactly is investment banking? For many outside the industry, the term conjures images of Wall Street, high-stakes deals, and complex charts on glowing screens. While not entirely inaccurate, the reality is far more nuanced. At its core, an investment bank acts as a financial intermediary. Think of it as a bridge. On one side, you have large corporations, governments, and other institutions that need capital, money to grow, to build, to innovate, or to acquire other companies. On the other side, you have investors, institutions, and individuals who have capital and are looking for opportunities to make it grow. Investment banks build and manage that bridge. They perform 2 primary functions. The first is raising capital. When a company wants to go public and sell its shares to the public for the first time, this is called an initial public offering, or an IPO. An investment bank underwrites this process. It helps the company determine its value, prepares the necessary regulatory filings, and markets the new stock to large institutional investors. Similarly, if a company needs to raise money by issuing bonds, which is essentially a form of debt, an investment bank facilitates that transaction, connecting the company with lenders in the market. The second primary function is providing advisory services. The most well-known of these is in the area of mergers and acquisitions, or M&A. If one company wants to buy another, it's an incredibly complex process. The investment bank acts as an advisor, helping to value the target company, structure the deal, negotiate the terms, and navigate the entire intricate financial and legal landscape. They might advise the buying company, known as the acquirer, or the company being sold, known as the target. These 2 functions, raising capital and advising on M&A, are the bedrock of the industry. The work is project-based, intense, and deadline-driven. A junior analyst isn't just sitting at a desk watching stock prices fluctuate. They are deep in the trenches, building complex financial models, preparing detailed presentations, and conducting exhaustive research to support these massive transactions. The stakes are incredibly high. A single deal can be worth billions of dollars and can reshape an entire industry, affecting thousands of employees and millions of consumers. This high-stakes environment is precisely why the skill set required is so rigorous. It's not just about being good with numbers. It's about a unique combination of analytical prowess, strategic thinking, relentless attention to detail, and powerful communication skills. The industry demands a level of precision and dedication that is unparalleled in many other fields. The hours are notoriously long, and the pressure is constant. Therefore, the individuals who succeed are those who have meticulously cultivated the right blend of hard and soft skills. In this series, we will explore the 5 pillars of that skill set. We will journey through the worlds of financial modeling and valuation, where art meets science to determine what a company is truly worth. We will delve into communication and presentation skills, learning how to distill mountains of complex data into a clear, compelling narrative for a CEO or a board of directors. We will examine the critical importance of attention to detail, a skill that can mean the difference between a successful multi-billion-dollar merger and a catastrophic failure. We will explore the art of a strong work ethic and resilience, understanding the mental and physical fortitude required to perform at the highest level under immense pressure. Finally, we will unpack the nuances of networking and relationship building, the often overlooked skill that fuels the entire industry. This first chapter is about setting the stage. It's about understanding the landscape before you try to navigate it. The world of U.S. investment banking is not just a job, it is a commitment. It is a choice to pursue excellence in a field that shapes the flow of capital and the direction of global business. The path is challenging, but for those who are prepared, it offers an unparalleled opportunity to learn, to grow, and to operate at the very center of the financial world. As we move into our next chapter, we will begin our deep dive into the first, and arguably most foundational, technical skill, financial modeling. We will explore what it is, why it is the language of finance, and what a junior banker is expected to build from their very first day on the job. Prepare to lay the first brick in the foundation of your knowledge. The journey to understanding what it truly takes to build a career in this elite field has just begun. Welcome back. In our first chapter, we established a bird's-eye view of the U.S. investment banking landscape. We discussed the industry's core functions and set the stage for our deep dive into the 5 essential skills for a career in this field. As promised, we now turn our attention to the first, and perhaps most foundational, technical skill, financial modeling. Before we proceed, let's quickly reiterate our guiding principle for this series. The content we are about to discuss is for educational and informational purposes exclusively. It is designed to provide insight into the professional practices and skills used within the investment banking industry. It does not represent any form of financial, investment, or career advice. For any personal decisions, consulting with a licensed professional is essential. So what is a financial model? At its most basic, a financial model is a tool, typically built in a spreadsheet program like Microsoft Excel, that forecasts a company's future financial performance. Think of it as an architect's blueprint for a business. An architect creates detailed drawings to show how a building will look and function before a single brick is laid. Similarly, a financial analyst builds a model to represent the financial structure and potential future of a company, based on a specific set of assumptions. It is a structured, logical summary of a company's operations, and it serves as a powerful decision-making engine. In investment banking, financial modeling is not just a task, it is the primary language used to communicate value and strategy. When a senior banker discusses a potential merger, or a client asks about the impact of a new product launch, the conversation is almost always grounded in the output of a financial model. It's the quantitative backbone that supports the qualitative story. It translates strategic ideas, like expanding into a new market or acquiring a competitor, into tangible financial projections. It helps answer critical questions like, what is this company worth? Or can this company afford to take on new debt? Or what will the combined company look like after this merger? The foundation of nearly every financial model is what is known as the 3-statement model. This refers to the 3 core financial statements that every public company is required to file: the income statement, the balance sheet, and the statement of cash flows. A skilled analyst understands that these 3 statements are not independent. They are intrinsically linked and tell a cohesive story about a company's financial health. Let's briefly touch on what each statement represents. The income statement shows a company's profitability over a period of time, like a quarter or a year. It starts with revenue, subtracts costs and expenses, and ends with the bottom line, net income. The balance sheet, on the other hand, is a snapshot in time. It shows what a company owns, which are its assets, and what it owes, its liabilities. The difference between assets and liabilities is the shareholder's equity. The fundamental equation here is always assets equal liabilities plus equity. Finally, the statement of cash flows tracks the movement of actual cash into and out of the company, breaking it down into operating, investing, and financing activities. The real skill in 3-statement modeling is linking them together. For example, the net income from the income statement flows into the statement of cash flows, and also affects the shareholder's equity on the balance sheet. A change in a capital expenditure assumption will affect assets on the balance sheet, which in turn impacts depreciation expense on the income statement. This intricate web of connections is what makes the model dynamic. It allows an analyst to change a single assumption, for instance, the revenue growth rate, and see how that change ripples through the entire financial picture of the company over the next 5 or 10 years. A crucial point to understand is that a financial model is not a crystal ball. Its output is entirely dependent on the quality of its inputs and assumptions. This is where the analytical work truly begins. Assumptions aren't just picked out of thin air. They are the product of rigorous research. An analyst will scour historical company filings, read industry reports, listen to management conference calls, and analyze economic data to inform their projections for revenue growth, profit margins, and other key drivers of the business. Furthermore, a good model is never built to provide just one answer. Instead, it's used to explore a range of possibilities. This is often done through sensitivity analysis. the analyst might ask, what happens to the company's value if interest rates go up by 1%? Or what is the impact on our cash flow in a best-case scenario versus a worst-case scenario? By building tables and charts that show the outcomes under different assumptions, the model provides a spectrum of potential futures, helping senior decision-makers understand risks and opportunities. For a junior investment banker, building these models is a core part of the job. It requires an exceptional level of precision, logical thinking, and a deep understanding of accounting principles. It is painstaking work where a single incorrect formula can throw off an entire valuation. This is why attention to detail, a skill we will cover in a later chapter, is so vital. In summary, financial modeling is the craft of building a dynamic financial blueprint of a company. It is a tool for analysis, valuation, and strategic decision-making. It is the language that translates business ideas into a quantitative framework. Mastering this skill is the first major technical hurdle for anyone aspiring to a career in investment banking. In our next chapter, we will build upon this foundation. We will take our understanding of financial modeling and apply it to one of the most common and important applications in the industry, valuation. We will begin to explore the different methodologies bankers use to answer that fundamental question. What is this company really worth? Welcome back to our series on the top skills for a career in U.S. investment banking. In the last chapter, we established that a financial model is the blueprint for a business, translating its operations into the language of numbers. Today, we take the logical next step, using that blueprint to answer the most fundamental question in all of finance. What is this company worth? This process is called valuation. As always, let's begin with our important reminder. This discussion is for educational and informational purposes only. We are exploring the professional methodologies used by financial analysts to advise corporate clients on large, strategic transactions. The concepts discussed here should not be construed as investment advice or a guide for personal stock selection. Always seek guidance from a qualified and licensed professional for your individual financial decisions. Valuation is both an art and a science. It's a science because it relies on rigorous financial models, accounting principles, and established methodologies. But it's an art because it requires judgment, experience, and a deep understanding of a company's competitive landscape, management team, and industry trends. There is no single magic number that represents a company's true value. Instead, investment bankers use several different methods to arrive at a valuation range. This range provides a reasonable field of play for negotiations, whether for an acquisition, an IPO, or a capital raise. Generally, valuation techniques fall into two broad categories: intrinsic valuation and relative valuation. Intrinsic valuation seeks to determine the value of a company based on its own inherent characteristics, primarily its ability to generate cash flow. The most common method here is the discounted cash flow, or DCF analysis. We will dedicate a full chapter to this later, but the core idea is that a company is worth the sum of all the cash it's expected to generate in the future, with a twist. Future cash is worth less than cash you have today. So you discount those future cash flows back to what they're worth in the present. The second category, which will be our focus for today, is relative valuation. This is often more straightforward to understand. Instead of looking inward at the company's own cash flows, relative valuation looks outward. It values a company by comparing it to what other similar companies are worth in the open market. The logic is simple and intuitive. If you were going to sell your house, one of the first things you would do is look at the recent sale prices of similar houses in your neighborhood. The same principle applies to businesses. The most common form of relative valuation is called comparable company analysis, often referred to as comps or trading comps. Let's break down how an analyst typically performs this analysis. The first step is to identify a universe of comparable companies. This is a critical step that requires significant judgment. An analyst looks for a group of publicly traded companies that are similar to the company they are trying to value. This similarity is judged on several criteria: industry, size, business model, geography, and financial characteristics like growth rates and profitability margins. For example, if you were valuing a large American software company, your peer group would consist of other large American software companies, not small European manufacturing firms. The second step is to gather the necessary financial information for this peer group. This means pulling data from public filings to find metrics like their current stock price, number of shares outstanding, total debt, and key performance figures like revenue, and a measure of profitability called EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. The third and most important step is to calculate valuation multiples. A multiple is simply a ratio that relates a company's value to a specific financial metric. Think of it as a standardized price tag. One of the most common multiples is enterprise value to EBITDA, or EV/EBITDA. Enterprise value represents the total value of a company, including both its equity and its debt, and EBITDA is a proxy for its operating cash flow. So an EV/EBITDA multiple of 10x means that the market is willing to pay $10 for every $1 of that company's annual operating cash flow. Other common multiples include the price to earnings, or PE ratio, and EV to revenue. The fourth and final step is to use these multiples to value the target company. The analyst will typically calculate the mean and median multiples for the entire peer group. They then apply that median multiple to the corresponding financial metric of the company they are valuing. For example, if the median EV/EBITDA multiple of the peer group is 12x, and the target company's EBITDA is $100 million, the implied enterprise value would be 12 times $100 million, or $1.2 billion. By using a range of multiples from the peer group, the analyst can generate a valuation range for their client. This output is often summarized in what's called a football field chart, which visually shows the valuation ranges implied by several different methodologies side by side. This helps clients see where the valuations from comps overlap with other methods, like the DCF analysis we mentioned earlier. It provides a comprehensive and defensible perspective on the company's potential worth in the current market environment. It is crucial to understand that comparable company analysis reflects the current sentiment of the market. It tells you what a company might be worth based on how investors are pricing similar companies today. This can be a double-edged sword. If the market is particularly optimistic and valuations are high across the board, comps will reflect that. Conversely, in a market downturn, the valuation derived from comps will be lower. This is why bankers never rely on just one method. By combining relative valuation with intrinsic valuation, they can present a more balanced and robust picture to their clients, grounding market sentiment with fundamental analysis. In our next chapter, we will continue our journey into valuation by diving deep into the cornerstone of intrinsic value, the discounted cash flow (DCF) analysis. We will unpack how analysts project future cash flows and the critical concept of discounting them back to the present day. Welcome back. In our last chapter, we explored the world of relative valuation, learning how investment bankers use comparable company analysis, or comps, to value a business based on the current market prices of its peers. Today, we shift our focus from the external market to the internal engine of the company itself. We are going to unpack the most famous method of intrinsic valuation, the discounted cash flow analysis, better known as the DCF. As we venture into this more technical topic, our guiding principle remains paramount. This content is for educational and informational purposes only. The DCF analysis is a sophisticated tool used by finance professionals to advise corporate clients. It is not a recommendation or a method for personal investment, and it should not be interpreted as financial advice. The goal here is to understand the theory and mechanics, not to produce actionable financial conclusions. So, what is the core idea behind a DCF analysis? It's built on one of the most fundamental concepts in finance, the time value of money. This principle states that $1 today is worth more than $1 tomorrow. Why? Because you could take that dollar today, invest it, and earn a return, making it grow to more than $1 by tomorrow. Conversely, a promise of $1 in the future is worth less than $1 today, because there is an opportunity cost and a risk you might not receive it. The process of calculating the present day worth of future cash is called discounting. A DCF analysis applies this exact logic to an entire business. It argues that the intrinsic value of a company is equal to the sum of all the cash it can generate for its investors in the future, with each of those future cash flows discounted back to its present value. It is a forward-looking approach that values a company based on its fundamental ability to generate cash. Let's walk through the main steps of building a DCF model at a conceptual level. First, an analyst must forecast the company's future cash flows. Specifically, they project what's known as unlevered free cash flow. In simple terms, this is the cash generated by the business's core operations after accounting for all necessary operating expenses and investments back into the business, but before accounting for payments to debt and equity holders. It represents the total pool of cash the company generates that is available to all of its investors, both lenders and shareholders. This forecast typically extends for a period of 5 to 10 years, and is derived directly from the three-statement financial model we discussed in Chapter 2. This is the most research-intensive part of the analysis, requiring deep understanding of the company's strategy and industry. Second, the analyst must determine an appropriate discount rate. If we are going to calculate the present value of future cash, we need a rate at which to discount it. This rate should reflect the riskiness of those future cash flows. A stable, predictable company is less risky, so its cash flows are discounted at a lower rate. A young, volatile company is riskier, so its cash flows must be discounted at a higher rate to compensate investors for taking that risk. The technical term for the discount rate used in a DCF is the weighted average cost of capital, or WACC. The WACC calculates a blended average of the cost of a company's equity and its debt financing. Calculating the WACC is a complex exercise in itself, but its purpose is simple: to serve as the hurdle rate that reflects the total risk of the business. Third, an analyst must estimate the value of the company beyond the initial forecast period. A healthy business doesn't just stop generating cash after 10 years. It's expected to continue operating indefinitely. The value of all cash flows beyond the explicit forecast period is known as the terminal value. There are two common ways to calculate this. One method assumes the company's cash flows will grow at a slow, stable rate forever, while another method assumes the company will be sold at the end of the forecast period for a certain multiple of its earnings, similar to a relative valuation. The terminal value often represents a very large portion of the company's total calculated value. Finally, the analyst brings it all together. They take each year's projected free cash flow and the calculated terminal value, and they discount each of these amounts back to its value in today's dollars using the WACC. The sum of all these discounted cash flows gives you the implied enterprise value of the company. The great strength of a DCF analysis is that it is grounded in business fundamentals. Its value is derived from assumptions about the long-term operational performance of the company, not the often volatile moods of the stock market. It forces the analyst to think critically about the key drivers of the business. However, the DCF model's greatest strength is also its greatest weakness. The final valuation is extremely sensitive to the assumptions used. A small tweak to the long-term growth rate assumption, or the discount rate, can change the final valuation dramatically. This is why analysts don't present the DCF as a single, definitive number. Instead, they present a range of values based on different scenarios and sensitivity analyses. This reinforces its role as a tool for understanding a company's value drivers, rather than as a crystal ball for predicting a precise price. In the world of investment banking, both DCF and comps are used in tandem. They provide two different but complementary perspectives on value. When the intrinsic value from a DCF and the market-based value from comps point to a similar range, it gives bankers and their clients greater confidence in their strategic decision-making. In our next chapter, we will complete our initial overview of valuation by examining one more common method: precedent transaction analysis, which adds another crucial layer to the valuation football field. Welcome back to our ongoing series exploring the essential skills for a career in U.S. investment banking. In our last two chapters, we've dissected two of the most important valuation methodologies. We learned how comparable company analysis provides a snapshot of current market sentiment, and how a discounted cash flow analysis builds a valuation from the ground up, based on a company's fundamental cash-generating ability. Today, we add the third and final pillar to our valuation framework: precedent transaction analysis. As we consistently emphasize, this exploration is for educational and informational purposes. The analytical techniques described are tools used by professionals to advise corporate entities on complex strategic matters. This content is not financial advice, nor is it a guide for making personal investment decisions. Professional consultation with licensed experts is crucial for any such choices. So what is precedent transaction analysis? At its core, it's another form of relative valuation, much like the comps we discussed earlier. But it answers a slightly different and very important question. While comps tell us what a piece of a similar company is worth in the public market today, precedent transaction analysis tells us what an entire similar company was worth to a buyer in the past. The analysis focuses on historical mergers and acquisitions to see what prices were paid when entire companies were bought out. The process for conducting this analysis is similar to that of comps. An analyst first screens for and selects a set of recent, relevant M&A deals. This selection process is critical. The analyst looks for transactions where the target company was in a similar industry, had a similar business model, and was of a similar size to the company they are currently valuing. The timing of the deal is also a key factor, as market conditions can change dramatically over time. Next, for each of these past transactions, the analyst will research the key deal details. They need to find the purchase price that the acquirer paid and the target company's financial metrics, like its revenue and EBITDA, at the time the deal was announced. Using this information, they calculate the valuation multiples that were paid, such as the enterprise value to EBITDA multiple. Finally, the analyst takes the median of these historical transaction multiples and applies them to the financial metrics of their target company to derive an implied valuation range. Now, this may sound almost identical to comparable company analysis, but there is one crucial difference that changes the entire dynamic: the control premium. When one company acquires another, the buyer is purchasing control of the entire business. This includes the ability to make strategic decisions, control the cash flows, and potentially create synergies by combining the two businesses. This level of control is inherently more valuable than owning a small, non-controlling stake through publicly traded shares. Because of this, an acquirer almost always has to pay a price that is significantly higher than the target company's stock price before the deal was announced. This additional amount is the control premium. For example, if a company's stock is trading at $20 per share, an acquirer might offer to buy the entire company for $26 per share, representing a 30% control premium. Consequently, the valuation multiples derived from precedent transaction analysis are typically the highest among the main valuation methodologies. They reflect not just the standalone value of a company, but the additional strategic value an acquirer was willing to pay to gain control. The strength of this method is that it is grounded in the reality of what has actually been paid for similar companies in real-world M&A deals. It provides a direct, evidence-based view of the valuation a company might expect if it were to be sold. This makes it an especially relevant tool when advising a client who is considering a sale of their business. However, this methodology also has its limitations. The past is not always a perfect predictor of the future. Market conditions from a transaction that happened 2 years ago, such as interest rates, economic outlook, and investor sentiment, might be completely different from today's environment. Furthermore, finding a set of truly comparable transactions can be challenging, especially in niche industries where M&A activity is infrequent. This brings us to the culmination of our discussion on valuation. An investment banker never relies on a single methodology. Instead, they use all three: comparable company analysis, precedent transaction analysis, and discounted cash flow analysis, to build a comprehensive and defensible view of value. The output is often visualized on a valuation football field chart. This chart displays the valuation ranges from each method as horizontal bars, allowing the client to see where the ranges overlap and how they compare. It provides a powerful summary that synthesizes market-based views, fundamental analysis, and historical M&A pricing, forming the bedrock of strategic financial advice. With this chapter, we conclude our initial deep dive into our first core skill: financial modeling and valuation. We have seen how a financial model acts as a blueprint, and how various methodologies use that blueprint to answer the critical question of what is it worth. In our next chapter, we will pivot from the quantitative to the qualitative. We will begin our exploration of the second essential skill for a career in investment banking: communication and presentation. After all, building a brilliant and complex financial analysis is only half the battle. The ability to clearly, concisely, and persuasively communicate your findings to a CEO or a board of directors is what truly separates a good analyst from a great one. Welcome back to our comprehensive guide on the top skills for a career in U.S. investment banking. For the last several chapters, we have been deeply immersed in the quantitative world of financial modeling and valuation. We learned how analysts build complex models and use sophisticated methodologies to determine a company's worth. Now we pivot. We move from the science of analysis to the art of influence. We begin our exploration of the second core skill, a competency that is just as critical as any financial model: communication and presentation. As we transition to this new topic, our foundational principle remains unchanged. This series is for educational and informational purposes. The skills discussed are in the context of professional development within the financial industry. This content does not constitute financial, investment, or career advisory services. For any such advice, please consult with a licensed professional. It is a common misconception that investment banking is a career suited only for quantitative geniuses who prefer the company of spreadsheets to people.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
While the analytical horsepower is non-negotiable, it is utterly incomplete on its own. A flawless multi-billion-dollar valuation model is useless if its conclusions cannot be communicated clearly, concisely, and persuasively. Analysis without effective communication is just a set of numbers. It has no meaning and no impact. Communication is the bridge that carries the insights from the spreadsheet to the minds of the decision-makers, the CEOs, CFOs, and boards of directors who rely on this information to steer their companies. Why is this skill so paramount? First, it's about translating complexity. Investment bankers operate in a world of intricate financial structures, dense legal documents, and volatile market dynamics. Their primary value is to distill all of that complexity into a clear, understandable narrative. A client needs to understand the strategic rationale for an acquisition, not just the math behind the valuation. They need to grasp the risks and opportunities, not just the outputs of a sensitivity analysis. An effective banker is, in many ways, an expert translator. Second, communication builds trust. The stakes in investment banking are astronomically high. Clients are entrusting bankers with the future of their companies. A banker who communicates with clarity, confidence, and transparency builds a foundation of trust. Conversely, someone who is confusing, uses excessive jargon, or cannot answer questions directly can quickly erode that trust, regardless of how brilliant their underlying analysis may be. Finally, communication is vital for internal collaboration. Banking is an intensely team-based profession. A junior analyst must be able to clearly explain their work to their associate. The associate must be able to summarize the team's progress to the vice president. A single miscommunication can lead to hours of wasted work, create errors in a presentation, and jeopardize a deadline. The entire workflow of a deal team is built on a scaffolding of constant, clear communication. In this field, communication primarily happens in two arenas: written and verbal. Written communication is the foundation, and its most common form is the pitch book or deck. This is a detailed presentation, typically created in PowerPoint, that serves as the central document for almost any client interaction. It might pitch a new idea, provide an update on a transaction, or present the final valuation analysis that a board of directors will use to make a decision. The creation of this deck is an exercise in logic, storytelling, and obsessive attention to detail. Every page, every chart, and every bullet point must serve a purpose in advancing the overall narrative. Verbal communication is the performance. It's the act of presenting the pitch book in a high-stakes client meeting, providing a quick update on a conference call, or defending an assumption during an internal review. It requires poise, articulation, and the ability to think on your feet and respond to challenging questions under pressure. For a junior banker, the initial focus is almost entirely on the written component. An analyst is the architect and builder of the pitch book. They are responsible for creating the slides, running the analysis, generating the charts, and ensuring every single number is perfect. While they may not be the one presenting to the client's CEO in their first year, their work is the script that the senior bankers will use. Their ability to structure information logically and write clearly is tested every single day. In essence, the quantitative analysis and the communication of that analysis are two sides of the same coin. One cannot be successful without the other. Over the next few chapters, we will delve deeper into both the written and verbal aspects of this critical skill. We will start in our next chapter by taking a closer look at the heart of written communication in banking, the art and science of constructing a compelling and flawless pitch book. Welcome back. In our last chapter, we introduced the second core skill for a career in investment banking: communication. We established that an analyst's brilliant quantitative work is only valuable if it can be communicated effectively. Today we delve into the primary medium for that communication, the foundational document of the entire industry: the investment banking pitch book, also known as a deck. As we proceed, we maintain our commitment to providing this information for educational and informational purposes only. This exploration of professional practices is not a form of financial, investment, or career advice. The creation and use of these materials in a real-world setting are governed by strict compliance and regulatory standards. For any personal advice, a licensed professional should always be consulted. A pitch book is far more than just a slideshow. It is a narrative machine. It is a meticulously crafted document designed to tell a compelling story, backed by rigorous data, that persuades a client to take a specific, high-stakes action. That action might be to hire the bank for a transaction, to acquire another company, to sell their business, or to raise capital. Every single page, chart, and bullet point is a calculated step in building a logical and convincing argument. The creation of a pitch book is a central activity for a junior banker. It is where their analytical skills and communication skills converge. Let's explore the typical anatomy of a pitch book to understand how this story is told. The book usually begins with an introduction and an executive summary. This is the hook. It crisply summarizes the purpose of the meeting and the bank's key recommendations. A busy CEO should be able to read the first 1 or 2 pages and understand the entire presentation's core message. This section is followed by an introduction to the bank and the specific deal team, highlighting their experience and expertise to build credibility and trust. Next comes the situational analysis or market overview. This section sets the stage. It demonstrates that the bankers understand the client's world. It will include an analysis of the client's current performance, its position within its industry, and the broader market trends, challenges, and opportunities that it faces. This section shows the why. Why is action necessary or advantageous right now? Following this setup, we arrive at the heart of the presentation, the strategic alternatives or the central recommendation. This is where the pitch is made. The bank might present a single bold idea, such as "we recommend you acquire company X." Or it might lay out several potential paths for the client to consider, such as selling the company, pursuing a merger, or raising capital for growth. Each alternative is presented with its strategic rationale, its pros and its cons. Of course, any strategic recommendation must be supported by rigorous financial analysis. This brings us to the valuation section. Here, all the work we discussed in our first 5 chapters comes to life. This section will feature the valuation football field chart, visually summarizing the company's worth based on comparable company analysis, precedent transactions, and the DCF model. The subsequent pages will show the detailed backup for each of these methodologies. This is the quantitative backbone of the story, providing the evidence that supports the strategic advice. Finally, the pitch book will often conclude with sections on deal structure and financial impact. If the recommendation is to acquire another company, how would that deal be financed? With cash, debt, or stock? What would the combined company look like? Crucially, what is the expected impact on the client's earnings per share? This is known as an accretion/dilution analysis, and it's a critical metric for public companies. The book then ends with an appendix, which contains all the supplementary data, detailed financial statements, and backup charts that don't need to be in the main body of the presentation, but are essential for reference. For a junior analyst, the process of creating this book is an intense combination of technical skill and creative problem solving. They are the ones pulling data from financial terminals, building the charts in Excel, and painstakingly linking them into the PowerPoint slides. They are responsible for ensuring every number is correct and ties out across the entire book. They are also responsible for the formatting, making sure logos are aligned, fonts are consistent, and colors match the bank's branding. This obsessive attention to detail, which we will cover as a skill in its own right, is absolutely critical. A great pitch book tells a seamless story. The market overview should logically lead to the strategic recommendation. The recommendation should be validated by the valuation analysis. And the financial impact analysis should confirm the benefits of the proposed action. The analyst's role is not just to be a slide maker, but a storyteller who uses data as their language. Now that we understand the anatomy of the written document, we can turn our attention to its delivery. In our next chapter, we will explore the other side of the communication coin, verbal presentation skills, and how bankers bring the story of the pitch book to life in the boardroom. Welcome back. We have journeyed from the complex world of financial modeling to the structured narrative of the investment banking pitch book. We've established what the analysis says and how it's written down. Today we address the final critical step in the communication process, how that story is told. We are moving beyond the document to discuss the skill of verbal communication and presentation, the ability to command a room and bring the analysis to life. As we begin, we reaffirm our commitment to providing this information for educational purposes. The professional skills and scenarios discussed are intended to provide insight into the investment banking industry. This is not a form of personal coaching or any kind of financial or career advice. For guidance tailored to your specific circumstances, please consult with a licensed professional. If the financial model is the script and the pitch book is the storyboard, then the verbal presentation is the live performance. It's where all the behind-the-scenes work is put to the test in a real-time, high-stakes environment. A common mistake is to think that presenting is simply reading the slides aloud. In reality, the slides are merely a visual aid. The speaker's role is to provide the narrative, the context, and the conviction that makes the data meaningful. It's important to set realistic expectations for a junior banker's role in this process. A first-year analyst will not be the one leading a multi-billion-dollar M&A pitch to a room full of C-suite executives. That role belongs to the senior bankers, the managing directors and partners who have spent decades building relationships and expertise. However, the junior banker's verbal communication skills are constantly being developed and tested in other, equally important ways. First, and most frequently, is internal communication. An analyst's primary training ground for verbal communication is within their own deal team. Before any document is sent to a client, it goes through numerous internal reviews. An analyst must be able to clearly and concisely explain their work to their associate, vice president, and other team members. They need to be able to answer questions like, "Walk me through your assumptions for this DCF model," or "Where did you source the data for this chart?" Being articulate and confident in these internal meetings is how an analyst builds trust and proves they are reliable. Second is the role of supporting the presentation. During a client meeting, the junior analyst is often present as the expert on the numbers. While the managing director is speaking, the analyst's job is to have an almost photographic memory of the pitch book they helped create. There is a classic, high-pressure moment in many meetings where a client will point to a specific number on a page and ask a detailed question. The senior banker will often turn to the analyst for the answer. In that moment, the analyst must provide a clear, correct, and concise response. There is no room for rambling or uncertainty. This is a direct test of their command of the material and their poise under pressure. So, what are the key elements of effective verbal communication in this environment? The first is clarity and conciseness. The leaders you will be presenting to are some of the busiest people in the world. They value directness. This means getting to the point quickly, a concept often referred to as BLUF, bottom line up front. It's about delivering the key insight first, then providing the supporting detail if needed. The second element is confidence and poise. This is not about being loud or arrogant. It's about projecting a calm and steady command of the material. This is conveyed through body language, good posture, steady eye contact, and vocal tone. A confident speaker demonstrates that they have done the work and believe in the analysis they are presenting. The third element is active listening. Communication is a two-way street. When a client or a senior banker asks a question, it is vital to listen carefully to what is actually being asked. A brilliant answer to the wrong question is useless. Active listening ensures that your response is relevant, targeted, and directly addresses the other person's concern. Finally, there is the skill of handling the question and answer session. This is often the most challenging part of any presentation. The key is preparation. A good analyst anticipates potential questions and knows their material inside and out. If a difficult question is asked, the best approach is to answer it directly and then, if possible, bridge back to the core message of the presentation. And crucially, it is vital to be honest. A response like, "That is an excellent point. I will need to confirm that specific detail and our team will follow up with you this afternoon," is infinitely better than guessing and being wrong. In our next chapter, we will transition to our third core skill, one that underpins the integrity of everything we have discussed so far, from the first number in a model to the last bullet point in a presentation. The unwavering discipline of attention to detail. Welcome back. We have journeyed through the intricate worlds of financial modeling and the persuasive art of communication. We've discussed how to build a valuation and how to tell its story. But underlying both of these skills, and indeed every single task in investment banking, is a foundational trait that can make or break a career. Today, we begin our exploration of the third essential skill, an unwavering, obsessive attention to detail. As we delve into this topic, we continue to uphold our core principle. This series is provided for educational and informational purposes. It is an exploration of professional standards and practices within the financial industry, and should not be interpreted as financial, legal, investment, or career advice. For any such guidance, it is imperative to consult with a qualified, licensed professional. In many professions, a small mistake, like a typo in an email or a minor miscalculation, is a trivial matter that can be easily corrected. In investment banking, this is not the case. The stakes are simply too high. A single misplaced decimal point in a financial model, an incorrect logo on a pitch book cover, or a misspelled name in a client communication can have catastrophic consequences. At best, it looks unprofessional and damages credibility. At worst, it can lead to a flawed valuation, incorrect strategic advice, and a complete loss of client trust. Therefore, attention to detail is not just a nice-to-have quality. It is the absolute bedrock of the profession. It is the invisible, non-negotiable standard that underpins the integrity of every piece of work. The numbers must be right. The formatting must be perfect. The logic must be flawless. There is zero tolerance for error. Why is this standard so unforgiving? First, it's about credibility. Imagine you are the CEO of a company, considering a billion-dollar acquisition. The bankers present their analysis, but you notice a simple addition error on page 12. Immediately, a seed of doubt is planted. If they missed this small detail, what other larger details might they have missed in their complex valuation models? The bank's credibility, which is its most valuable asset, is instantly compromised. Every number and every statement must be perfect to maintain the client's absolute confidence. Second, it's about complexity management. As we've discussed, financial models and presentations are incredibly complex. A pitch book can be over 100 pages long, with hundreds of numbers, all of which are interconnected. A change on page 5 must be reflected accurately on page 50. The only way to manage this level of complexity is with a systematic, detail-oriented process. An analyst must be able to track every data point from its source to its final presentation, ensuring consistency and accuracy throughout. Third, it's a reflection of respect. Producing a flawless document shows respect for the client, for the senior members of your team, and for the work itself. Presenting a document with careless errors signals that you either didn't care enough or weren't disciplined enough to get it right. In a culture that values excellence and precision above all else, this is a fatal flaw. For a junior banker, this skill is tested from day one. The work you produce is expected to be zero defect. This means that before any document is sent up the chain to an associate or vice president for review, the analyst is expected to have checked it, double-checked it, and triple-checked it for any possible error. This includes everything from the mathematical formulas in Excel to the alignment of logos on a PowerPoint slide. This relentless focus on detail can be one of the most challenging adjustments for those entering the industry. It requires a fundamental shift in mindset. It's about slowing down to go fast. It's about taking the extra time to print out a document and review a physical copy rather than just reading it on screen. It's about methodically checking every single number against its source. It's about developing a personal system of checks and balances to ensure that your work is, without question, perfect. This may sound daunting, and it is. The pressure to be perfect is immense. However, it is through this rigorous process that analysts develop the discipline and habits that will serve them for their entire careers. An analyst who masters this skill becomes an utterly reliable member of the team, someone whose work can be trusted implicitly. And in investment banking, trust is everything. In our next chapter, we will discuss the practical techniques and tools that bankers use to ensure this high level of accuracy, and how they turn the abstract concept of attention to detail into a concrete, repeatable process. Welcome back. In our previous chapter, we established that an obsessive attention to detail is the non-negotiable foundation of an investment banking career. We discuss why this standard of perfection is so critical for maintaining credibility and trust. Today, we move from the why to the how. A mindset of precision is essential, but it must be supported by a disciplined, repeatable process. This chapter is about the practical tools and techniques that bankers use to make their work flawless. As we continue, let's reaffirm our commitment. This series is created for informational and educational purposes only. We are exploring the professional habits and skills required within a specific industry. This is not a form of financial, investment, or career advice. For guidance relevant to your personal situation, seeking consultation with a licensed professional is always the correct course of action. Achieving a zero-defect work product is not about having superhuman abilities. It's about having a system. Here are some of the core techniques that junior bankers learn and master to ensure the quality of their work. First is the print and proof method. After staring at a digital document for hours, your brain becomes fatigued and starts to automatically correct errors on screen. Printing a physical copy of a pitch book or a memo changes how you interact with it. It forces you to see the work with fresh eyes. Analysts will often take a ruler to the printed page to manually check the alignment of text boxes and logos. They use a red pen to circle typos and mark inconsistencies. This tactile process is incredibly effective at catching formatting errors, awkward page breaks, and other mistakes that are easily missed on a monitor. Second is the discipline of source checking and tying numbers. In any presentation, every single number must be traceable to its original source. This process is called tying out the numbers. It means an analyst can point to a figure on a slide and track it all the way back, from the PowerPoint chart, to the specific cell in the Excel model, to the raw data input from a public financial filing or a data provider. This creates a bulletproof audit trail. There are no magic numbers or approximations in a final work product. This painstaking process ensures every calculation is correct and every piece of data is defensible. Third is a simple but powerful proofreading technique. Reading aloud or reading backwards. When you read silently, your brain often fills in what it expects to see, skipping over small errors. Reading a passage aloud forces you to slow down and process each word individually, making it much easier to catch grammatical mistakes or sentences that are phrased awkwardly. Similarly, reading a document backwards from the last sentence to the first disrupts the narrative flow and forces your brain to focus on the mechanics of each sentence, which is highly effective for catching typos. Fourth is the crucial practice of getting a fresh eyes review. No matter how disciplined you are, after spending 10, 12, or more hours on a single document, you will develop blind spots. The best analysts know when to step away. They might take a short break, switch to a different task for an hour, or most effectively, ask a fellow analyst on their team to review their work. A colleague who has not been immersed in the document can often spot an obvious error in seconds that the original author might miss for hours. This team-based quality control is a fundamental part of the banking workflow. Finally, many analysts develop and use personal checklists. For a complex, multi-step process like preparing a pitch book, a checklist ensures that nothing is forgotten. This list might include items like: confirm all page numbers are correct, run spell check on the entire document, ensure all chart titles are in the proper format, and verify the date on the cover page is correct. This systematizes the final review process and turns the pursuit of perfection from a vague goal into a manageable series of tasks. These techniques are not shortcuts. They are habits of discipline. They are the mechanics that ensure the final product is worthy of a client's trust. By building these systems, an analyst creates a reputation for reliability, which is one of the most valuable currencies they can earn. Having covered the bedrock skill of attention to detail, we now turn to the force that powers all the skills we've discussed, the engine of execution. In our next chapter, we will begin to explore our fourth core skill, the immense work ethic and resilience required to thrive in the demanding environment of investment banking. Welcome back to our series on the essential skills for a career in U.S. investment banking. We have meticulously covered the analytical, communicative, and detail-oriented precision required for the job. But what powers these skills? What allows an individual to perform complex financial modeling, craft perfect presentations, and check every detail, day after day, under immense pressure? The answer lies in our fourth core skill, the engine of execution. An extraordinary work ethic and its vital counterpart, resilience. As we explore this demanding topic, we hold to our foundational commitment. This series is for informational and educational purposes only. It is an objective look at the professional expectations within an industry, and does not constitute financial, career, or health advice. For any personal guidance, please consult with a licensed and qualified professional. The legendary work ethic of investment banking is perhaps its most famous, and often misunderstood, attribute. It is not simply about working long hours for the sake of appearances. Instead, it should be understood as a combination of three distinct elements: capacity, commitment, and consistency. Capacity is the ability to manage a large volume of complex tasks simultaneously under tight deadlines. Commitment is a deep-seated sense of ownership, treating every task, no matter how small, as a reflection of your own personal standards. And consistency is the ability to maintain that high level of performance over extended periods. To understand why this level of work ethic is the industry standard, it's important to understand the structural nature of the job itself. The long and unpredictable hours are not arbitrary. They are a direct result of the work's demands. First, the industry is entirely deal-driven. The workflow is not a steady, predictable 9-to-5 stream. It is project-based and moves in intense bursts dictated by the life cycle of a transaction. When a client decides to pursue a merger or an IPO, the timeline is often aggressive and inflexible. The work required to meet those deadlines must be completed, regardless of the time of day or day of the week. Second, it is a client service business of the highest order. The clients are CEOs and CFOs of major corporations, individuals who are also working around the clock. If a client has a request at 7 p.m. for a new analysis needed for a board meeting the next morning at 8 a.m., the team is expected to deliver it. The bank's role is to be a responsive, reliable advisor, and that requires constant availability. Third, the pursuit of perfection takes time. As we discussed in our chapters on attention to detail, the zero-defect standard is absolute. The process of building, checking, revising, and rechecking a complex financial model and a 100-page pitch book is inherently time-consuming. This iterative process of refinement, driven by feedback from senior bankers, is a primary reason why the hours are so long. It is critical to note that the culture is results-oriented. It is about the quality and timeliness of the output, not simply the amount of time spent at a desk. An analyst who can work efficiently and produce flawless work is more valued than one who is merely present. The goal is to be productive and reliable, and the demanding schedule is a byproduct of that goal. This is where the second part of this skill, resilience, becomes so important. Work ethic is the force that gets you through a challenging project. Resilience is the mental and emotional fortitude that gets you through a challenging career. It's the ability to handle intense pressure, to receive critical feedback without taking it personally, and to bounce back quickly from the inevitable setbacks and long nights. Successfully navigating this environment requires individuals to develop robust personal strategies for managing stress and maintaining focus. High-performing bankers are not machines. They are individuals who have learned how to operate in a high-performance environment. This involves developing habits that allow them to sustain their energy and mental clarity over the long term. In essence, the work ethic is the tangible output of your dedication, while resilience is the internal framework that makes that output sustainable. One without the other is incomplete. In our next chapter, we will focus more deeply on the crucial skill of resilience. We will explore the mindset and practical strategies for managing pressure, learning from feedback, and maintaining the long-term perspective needed to not just survive, but to thrive in this demanding profession. Welcome back. In our last chapter, we characterized the investment banking work ethic as the powerful engine of execution. Today, we focus on its essential counterpart, the armor that protects that engine. We are talking about resilience, the mental and emotional fortitude required to navigate the high-pressure, high-stakes environment of investment banking. This is not a passive trait you are either born with or not. It is an active skill that can be intentionally cultivated. As we explore this topic, we strictly adhere to our guiding principle. This content is for educational and informational purposes only. The discussion of mindset and professional habits is intended to provide insight into a demanding career path. It does not constitute any form of health, financial, or career advice. For any personal guidance, consulting a licensed professional is the appropriate action. Resilience in a professional context is the ability to withstand pressure, recover from setbacks, and adapt to constant change and challenge. In investment banking, this skill is tested daily. Let's break down the key mindsets that form the foundation of professional resilience. The first and most critical component is decoupling feedback from your identity. A junior banker's work is under constant scrutiny. You will receive feedback that is direct, blunt, and frequent. A pitch book you spent all night on may come back covered in red ink. A model you built will be rigorously stress-tested for errors. A resilient analyst understands that this feedback is about the work product, not about their personal worth or intelligence. They adopt a growth mindset, viewing every critique not as a failure, but as a valuable lesson on how to improve. They see feedback as a gift that accelerates their learning, rather than as a personal attack. This mental shift is fundamental to long-term success. The second component is maintaining perspective. The day-to-day reality of the job can be all-consuming. It's easy to get lost in the urgency of a single project or the frustration of a difficult task. Resilience is the ability to zoom out and see the bigger picture. It's understanding that a career is a marathon, not a sprint. One tough project, one late night, or one negative comment does not define your entire career. Resilient individuals focus on their overall trajectory. They ask themselves, am I learning? Am I developing new skills? Am I a better analyst today than I was 3 months ago? This long-term view helps to moderate the emotional highs and lows of the daily grind. The third component is the practice of extreme ownership. In a complex, fast-paced environment, mistakes will happen. The resilient response is not to assign blame or make excuses, but to take ownership. This means acknowledging the error, focusing immediately on a solution, and most importantly, learning from the mistake to ensure it is not repeated. This attitude demonstrates maturity and accountability, and it builds trust with senior team members far more effectively than trying to appear perfect. Taking ownership transforms a potential failure into a powerful learning opportunity. The fourth component is focusing on what you can control.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, you agree not to hold the creator liable for any loss or damage arising from your use of the information provided.
An analyst cannot control market fluctuations, last-minute client requests, or the timeline of a deal. Wasting mental and emotional energy on these external factors is a direct path to burnout. A resilient individual consciously directs their focus toward the things they can control. The quality and accuracy of their own work, their attitude and professionalism, their responsiveness, and their commitment to being a reliable team member. By focusing on their own actions and efforts, they maintain a sense of agency and purpose, even when the external environment is chaotic. It is also important to acknowledge that professional resilience is supported by sound personal habits. While this series does not provide health advice, it is a well-understood reality in high-performance fields that individuals must develop their own effective strategies for managing energy and stress to sustain their professional efforts over the long term. In our next chapter, we will begin our exploration of the fifth and final skill in our series. This is the skill that transitions an individual from being a great analyst to building a great career. We will delve into the world of networking and relationship building. Welcome back to our final segment in this series on the top skills for a career in U.S. investment banking. We have covered a vast amount of ground, from the deep analytical skills of valuation, to the art of communication, the discipline of detail, and the engine of work ethic and resilience. These are the skills that allow you to do the job. Now we turn to the fifth and final skill, the one that allows you to build a career. We will explore the world of networking and professional relationship building. As we conclude our series, we reinforce our foundational principle one last time. This content is for educational and informational purposes. The discussion of career strategies and professional practices is based on general industry observations and is not a form of financial, investment, or guaranteed career advice. For guidance on your specific professional path, consulting with mentors and career advisors is recommended. The term networking often conjures images of awkward conversations and the superficial exchange of business cards. In the context of a long-term career in finance, it is essential to redefine this concept. It is not about collecting contacts. It is about cultivating genuine, trust-based professional relationships over time. While junior banking roles are heavily focused on executing technical tasks, senior banking roles are almost entirely about relationships. At the highest levels, finance is a people business. Deals are awarded, negotiated, and closed based on the trust and rapport between individuals. The foundation for those future relationships is laid on day one of a banking career. For a junior banker, relationship building happens in two primary arenas: internal and external. The most important, yet often overlooked, arena for an analyst is internal networking. Your first and most critical network is the one that exists within the walls of your own firm. This means building strong, positive working relationships with your fellow analysts, the associates and vice presidents you work for, and even the administrative and support staff who are crucial to the team's operations. Why is this so critical? Your internal reputation determines the quality of your experience. Associates and VPs will want to staff the analysts they trust and enjoy working with on the most interesting and important deals. When you are struggling with a complex Excel formula at 2 a.m., it is your relationship with your peers that will determine if someone is willing to help. Your internal network is your source of mentorship, your support system, and your passport to the best opportunities for learning and advancement within the bank. This kind of networking is not done at formal events. It is done through your daily actions, delivering flawless work, maintaining a positive and collaborative attitude even under pressure, offering to help a teammate who is overwhelmed, and showing genuine curiosity about the projects others are working on. The second arena is the beginning of your external network. It is understood that a junior analyst is not expected to have a Rolodex of CEO contacts or to bring in new clients. However, they are expected to begin planting the seeds for their future professional network. This typically involves connecting with peers at a similar level. These are the other young professionals you may interact with on a deal: the junior lawyers at the law firm or the junior accountants at the accounting firm. It includes alumni from your university who are also starting their careers. The purpose here is to build a cohort of contemporaries who will grow and advance in their careers alongside you. The analyst you work opposite from on a deal today might be a key decision maker at a client or a private equity firm a decade from now. These early connections, built on mutual respect and shared experience, can become incredibly valuable over the long term. There are a few key principles to effective relationship building. First, be a giver, not a taker. Always think about how you can add value to others before asking for anything. Second, be authentic and curious. The most effective networkers are genuinely interested in learning about other people and their work. They ask thoughtful questions, and they listen to the answers. But the single most powerful networking tool an analyst possesses is their reliability. Being known as the analyst who is smart, dependable, and produces exceptional work is the fastest way to build a stellar reputation, both inside and outside the firm. Your work product is your best business card. In our next chapter, we will discuss some of the practical applications of these principles, the how-to of networking, including preparing for events and conducting professional informational interviews. Welcome back. In our previous chapter, we redefined networking not as a transactional activity, but as the long-term art of building genuine professional relationships. We established that for a junior banker, this begins with building a stellar internal reputation. Today, we move into the practical application of these principles. This chapter is the toolkit, the how-to guide for actively and professionally cultivating your network. As we proceed, we maintain our unwavering commitment that this series is for informational and educational purposes only. The professional strategies discussed are meant to provide insight and context. They do not constitute financial, investment, or direct career advice. For guidance on your personal career journey, consulting with mentors and advisors is always the recommended approach. One of the most foundational activities in professional networking is the informational interview. This is not a job interview. Rather, it is a brief, focused conversation with someone in your field, or a field you are interested in, with the primary goal of learning from their experience and insights. The key to a successful informational interview is preparation. Before you ever reach out, you must do your homework. Research the individual's career path using professional networking sites like LinkedIn. Understand their current role, their company, and their background. Based on this research, prepare a list of thoughtful questions that cannot be answered with a simple web search. Your goal is to show that you have invested your own time, and that you value theirs. The outreach itself should be professional and concise. A short, polite email is typically the best approach. Introduce yourself briefly, explain how you came across their profile, and state your goal. That you are hoping to learn from their experience and would be grateful for 15 to 20 minutes of their time at their convenience. Acknowledging how busy they are shows respect. During the conversation, the focus should be entirely on them. Ask your prepared questions, be an engaged and active listener, and be extremely mindful of the time you requested. As the interview nears its end, thank them for their time and their insights. The most critical step comes after the conversation. A prompt and personalized thank you email. Reference a specific piece of advice or an interesting point they made to show that you were listening carefully and truly valued the discussion. Another common scenario is the networking event. These can be industry conferences, alumni mixers, or firm-sponsored gatherings. Walking into a room full of strangers can be intimidating, but a strategic approach can make it highly effective. First, have a realistic goal. Your aim is not to meet every person in the room, but to have 2 or 3 quality conversations. Second, be prepared with a concise and clear way to introduce yourself and a few open-ended questions to ask others. The best question is often the simplest. What are you working on that you find exciting right now? The golden rule of networking events is to listen more than you talk. People appreciate a curious and engaged listener. Finally, learn how to make a graceful exit. After a good conversation, you can simply say, "It was a pleasure speaking with you. I want to be sure to meet a few other people, but I hope we can connect again." Lastly, it is crucial to leverage digital tools professionally. Your LinkedIn profile, for example, is your digital handshake. It should be professional, complete, and up-to-date. When you send a connection request, always include a personalized note. A generic request is easy to ignore, but a note that says, "It was great speaking with you at the conference last night about industry trends," creates an instant connection. Building a network is a marathon, not a sprint. These activities are not one-time events. They are part of a continuous process of building and maintaining professional relationships throughout your career. Every interaction is an opportunity to build your reputation as a thoughtful, curious, and reliable professional. In our next and final chapter, we will bring everything together. We will synthesize all 5 core skills and look at how they integrate and operate in the dynamic, day-to-day life of an investment banker, providing a holistic conclusion to our series. Welcome back for the final chapter in our comprehensive journey through the top 5 skills for a career in United States investment banking. Over the last 14 chapters, we have systematically dissected the core competencies required to succeed in this demanding field. We explored the analytical foundation of financial modeling and valuation. We delved into the art of communication and presentation. We stressed the non-negotiable bedrock of attention to detail. We examined the engine of execution, work ethic and resilience. And finally, we uncovered the long-term value of networking and relationship building. Today we bring it all together. These skills do not operate in isolation. They are a deeply integrated and interdependent toolkit. The truly successful banker is one who can seamlessly weave these competencies together in the fast-paced, high-stakes environment of a live transaction. To illustrate this, let's consider a hypothetical scenario. A client is considering the acquisition of a competitor, and your team has been engaged to advise them. The process begins with work ethic and resilience, skill 4. The project will demand long hours and intense focus from the very start. The team must be prepared to fully commit to the client's aggressive timeline. Immediately, the analyst's financial modeling and valuation skills, skill 1, are called upon. They are tasked with building a detailed financial model of the target company to determine a defensible valuation range. This involves a DCF, a comparable company analysis, and a review of precedent transactions. This is the core analytical work that will form the basis of all advice. Throughout every step of this analysis, an obsessive attention to detail, skill 3, is paramount. The analyst checks and rechecks every formula, ties out every number to its source, and ensures the integrity of the data. A single error could compromise the entire valuation and the advice given to the client. As the analysis takes shape, communication and presentation skills, skill 2, come to the forefront. The analyst works with the team to translate the complex model into a clear and compelling narrative within a pitch book. They create charts that visualize the valuation, and they write bullet points that summarize the strategic rationale. This process is iterative, requiring the resilience, skill 4, to accept and incorporate direct, critical feedback from senior bankers to refine the story. Simultaneously, networking and relationship building, skill 5, are at play, even for the junior analyst. Their strong internal network allows them to collaborate effectively with their team, and perhaps get quick insights from an industry expert in another group within the bank. Meanwhile, the senior bankers are leveraging their deep external relationships with the client's management team to guide them through the decision-making process. In the final presentation, all skills converge. The senior banker presents the flawless pitch book that the analyst helped create. Their verbal communication is clear and confident because they trust the underlying analysis. When the client's CEO asks a pointed question about a specific number, the team can answer with precision because their attention to detail was unwavering from the start. This is the integrated banker. It is an individual who can execute a complex analysis, communicate it with clarity, ensure its perfection, sustain the effort required to get it done, and do it all within a framework of professional relationships. As we conclude this series, let us end with a final, important reminder. This entire series has been produced for educational and informational purposes only. The goal was to provide a high-level overview of the professional skills and practices within the U.S. investment banking industry. The content provided does not constitute, and should not be interpreted as financial, investment, legal, tax, or career advice. The world of finance is complex and regulated. For any decisions related to your finances or your career, it is absolutely essential that you consult with licensed, qualified professionals who can provide advice tailored to your unique situation. The path to a career in this field is challenging, demanding a unique blend of intellectual horsepower and personal fortitude. However, for those who cultivate these 5 core skills, it offers an unparalleled opportunity to learn, to grow, and to operate at the very center of the global economy. Thank you for joining us on this journey.
Disclaimer: the information presented is for informational purposes only and is not professional financial, investment, or tax advice. All investments involve risk and may result in partial or total loss. You should always conduct your own research and consult with a qualified financial professional before making any financial decisions. By viewing this video, You agree not to hold the creator liable for any loss or damage arising from your use of the information provided.